All right. Thank you, everybody, for joining us. It looks as though we've got folks dialed in. A couple of housekeeping notes before we get started. No, it's not. Let's see. Thank you for joining us for the July Enterprise Risk Management Toolbox webinar. A couple of housekeeping notes. If you've dialed in by phone but haven't logged in by computer and you'd like to see the slides that will be shown, please point your web browser to readytalk.com. In the box where it says Participant, Join a Meeting, enter the same access code that you used to join today's call, 987-9821. Please stay aware of the level of background noise in your area, and if it becomes noisy, please put your phone on mute. If you're called away from your phone, please do not put your phone on hold, because that will cause your hold music to be transmitted to everybody else. You can simply hang up, and then when you're free, dial back in again, and it will not disrupt the call. We are leaving the phone lines open and unmuted, so if you have questions, you can ask them as they come up. Also, the chat box in the lower left corner of your screen is available if you want to send a question and not interrupt the flow of the presentation. Additionally, we'll have time for questions and answers at the end. So I will now please introduce Les Bowner, who is the Managing Director of Willis North America's Captive Practice. Les?
Well, thank you, Emily. I appreciate the opportunity to stand in for Sean, who is currently winging his way out to California to join you. And what I'd like to, I gather this is the second of one of these webinars to give you an overview of captives. I will tell you that you're going to cover a lot of territory today. So it's much more of a captive primer through Captive 201, and feel free to ask questions or stop me as we go through. First of all, I'd like to congratulate the university for making the decision to form a captive. While the technical definition is it's a limited purpose licensed insurance company, it is very much a financial tool. And it's a financial tool that performs a number of very valuable risk management functions. And as a tool, if you have one, you can use it, and if you don't, you can't. So to make the decision to get one will suddenly give the UC system a tremendous amount of flexibility in managing their risk. The distinguishing characteristic about a captive is that it essentially provides an insurance wrapper around self-insurance reserves. So it gives you the ability to get insurance accounting treatment rather than pure accounting treatment. And that allows you to manage your losses, manage your risks, take on increasing or in fact decreasing levels of risk. I think one of the biggest flaws that we see once a captive is operational is that the groups that have formed it use a static risk management strategy and not a dynamic risk management strategy. So it's very flexible. It's very dynamic. You can change it as you change your risk management strategies, either annually or even quarterly. But fundamentally, it allows you to put an insurance wrapper around self-insurance reserves. It can also form a insurance assumption vehicle. As you build your capital, you can take pure insurance risk. It can be either an insurance company and issue direct policies, or a reinsurance company and assume risk. And it is specially designed and focused to reinsure the risks of the particular parent or the group of companies that have formed it. Let's get the next slide up. Here we go. Here you've got the four main reasons or the four main uses for captives. Retained risk is very much for self-insurance reserves. But it does allow you to have the accounting treatment to take on, and that can be very useful for taking on increased levels of risk. It becomes, many groups, many organizations feel much more confident when they've got a healthy captive in taking on increasing levels in a hardening insurance cycle. Gives you a lot of flexibility. Reinsurance. And in some cases, there's not a lot of rhyme or reason or logic behind this, but in many, it gives you a broader access to the reinsurance market, and that reinsurance market can be more competitive as reinsurance of a captive than it would be as insurance of a group or a company. And for instance, we're finding that with healthcare reform in this country, and because organizations now have to provide unlimited health benefits, there's no longer a lifetime maximum, that even companies that were totally self-insured are now looking at purchasing medical stop-loss coverage for their medical benefits. The reinsurance market is much more competitive for reinsurance than it is for insurance of stop-loss. Access to capacity. TRIA, and we'll talk about this a little bit later on. But the Bermuda market, in many cases, is available as reinsurance of a captive, will not be available as insurance for North American risks. And then third-party business, which is not only third-party business for the captive, but it's also the opportunity for the captive to be a value contributor to an organization, to be a profit center, to take on risk that is risks that you're familiar with, measurable, that you know, that you're confident assuming, and have built up the capital to do so. One of our clients is using a very successful third-party unrelated premium component to generate the capital for their fundamental property and casualty requirements. Now, before we go any further, are there any questions at all on the general nature of captives and the utilization of captives? Okay, now what we'll do is we'll discuss just what the objectives are, or the direction that you're headed for the UC in the Phase 1 implementation of your captive. And initially is to use it, which is not uncommon, for retained risk or self-insurance reserves, workers' compensation, auto liability, general liability. And the captive will give you the insurance company a wrapper for what is presently assumed as an accrual. There is, at this point in time, there is not it's not contemplated being used for risk transfer rate arbitrage, but it will be used for access to capacity for terrorism, which is a very effective use of the captive. We currently have 27 terrorism captives here at Willis that we manage, and it'll also be used to generate surplus in capital through assuming third-party business with your small vendor program. Now, deductible reimbursement. Typically, and deductible reimbursement can apply to any frequency, low severity line that you're currently assuming or wish to assume. Workers' compensation works extremely well, as does GL and AL. Product or service warranties, which I don't necessarily think would apply to the university, I could be wrong. Construction exposures, OSIPs, very effective. Environmental liability. You can extend it to property and business interruption. And we're seeing almost an exponential increase in inquiries for employee benefits, and particularly for self-insured medical, for either assuming the stop-loss risk or facilitating the purchase of stop-loss coverage now that the parameters have changed. I think we basically covered this. It's frequency, any frequency line, long tail line, not particularly severity driven, is a very good candidate for issuing a deductible reimbursement policy. The distinguishing feature for deductible reimbursement policies is that it typically will not replace an insurance purchase. It will make the insurance purchase of the risk transfer program more competitive. And it would be, the purchase of that program would be tailored specifically for either the market or the identified levels of self-insurance that entity wishes to assume. So for instance, and it gets back to what we spoke about, what I mentioned earlier, I was going to say, bless you, you very much want to have a dynamic captive strategy. And that dynamic captive strategy can be driven off of the capital of the captive. It gives you the flexibility to take on increased levels of retention. There's a particular company I'm very familiar with that's private. That company identifies the level of self-insurance that it will assume off of the parent's balance sheet. Now, because they're private, they have the luxury of being able to assume a volatility that many public entities wouldn't be in a position to assume. And their decision-making process is not driven off of the insurance market. In fact, their stated objective is only to protect the balance sheet, not the income statement. So they take enormous levels of self-insurance, and it's driven off of the parent's balance sheet. But once you've made the determination, either through market or capital or a combination, which is typically the driver behind making that decision, then what differs is that you will purchase a risk transfer program. So, for instance, for workers' compensation, you'll continue to purchase a statutory excess policy, and the captive will, in fact, issue a direct policy to the parent, assuming the self-insurance layer. That depending on availability of stop loss, you can really complete that puzzle by protecting the aggregate level of intention through some type of stop loss vehicle. And it works very, very smoothly. Very common structure. I'd say the casualty deductible reimbursement programs that are capped with an excess policy or a statutory work comp policy are our most common structure for the captives that we manage. Here we go. Access to capacity. This is the second objective of the UC captive. And that's to access the terrorist pool. And what's interesting is that, and you may be, and we'll go through some of the mechanics of the effect. So let me just run through this and then we'll get into the mechanics. But fundamentally, you can make a decision to self-insure the terrorist exposure, but which is a prudent risk management decision, but by making that decision, you don't have access to the TRIA pool. The TRIA pool is only available to insurance companies. So without a captive, if you make the decision to self-insure TRIA exposures, and your underwriters will give you that option, for most lines of business, doesn't apply to work comp, you can make a prudent economic risk management decision, but the protections of the TRIA pool will not be available to you. A captive will give you that flexibility. Sean and I spent some time with the Treasury Department to confirm that in fact was the case, and they not only confirmed it, they aggressively support it. And they do it because part of the reason of TRIA is to broaden the application of insurance, to make it easier for insurance companies to provide broader coverage. And that's the way the Department of Treasury views their mandate. So it does, and this is particularly appropriate, I think, for research institutions. It gives you access to nuclear contamination, biological and radiation contamination, which would typically not be available in the consumer marketplace. So a captive not only gives you the ability to access TRIA for conventional coverage, but it also gives you the ability to broaden the access because of TRIA protection. And we were comfortable with what the Act said, but it was validated by the Department of Treasury, and we intend to have a regular meeting with them to make sure that we are making the correct representations on what the TRIA protection will and will not do. Now, to access TRIA, it's reasonably complicated in the sense that you first have to have a certified TRIA event. That has to exceed $5 million. Once it's been identified as a TRIA event and it's exceeded $5 million, you don't actually get TRIA protection until it exceeds $100 million. So that the captive is actually at risk until the entire 12-month accumulation of TRIA events exceeds $100 million. Once that event occurs, your particular event will be subject to a deductible of 20% of the premium, and then you will take a 15% quota share participation, at which point TRIA will provide up to $100 billion of coverage, which is an aggregate across all events in a 12-month period. That could put the university at risk for a substantial event. Most of the TRIA programs that we put together elect to purchase reinsurance, which is readily available in the conventional market for the retention that's been assumed by the captive. So what that means is that what TRIA will not provide, the reinsurance market will, and to date it's been at a very competitive price. So I would be hard-pressed to think of which one of the 27 we have that has not elected to take advantage of this coverage. Are there any questions? Because TRIA can be complicated. Okay. Here we go. As far as the UC system is concerned, you've reviewed the consulting analysis. You've received a formal feasibility study which will provide you with the cost-benefit analysis of forming a captive. You have made the decision to proceed with that captive's formation. And we're now in the process of developing and designing the business plan, which I believe is the purpose of Sean's visit to California today and tomorrow, following which we will use the material that's been accumulated in the business plan, which typically is derived from the feasibility and consulting analysis, to prepare an application to license and incorporate that company, at which point you'll provide the necessary capitalization and start to execute an initial strategy for accumulating surplus in capital. Phase 2 and beyond, on the execution of a successful captive strategy, you then have the opportunity to look at other coverages. UC contractors, insurance programs, very typical, medical malpractice for community physicians. We're seeing a very identifiable trend of hospitals starting to incorporate local physician practices. That raises the question of tail coverage, on how to provide tail coverage for those physicians. And in many cases, that's being provided by either a new captive that's been formed for that purpose or an existing captive that the hospital has provided. You've got various other third-party components of coverage that you can provide for both the students, alumni, employees of the university. Areas of frustration where you have not been able to manage commercial insurance capacity offers you an opportunity to either provide it or purchase it as a reinsurance vehicle. We find, almost without exception, that when we get involved in unique insurance coverages, that they're suggested by the client themselves. We understand the business very well, but we don't understand your business to the degree that you do, or that the needs are that you've identified that you will. So inevitably, new and innovative coverages are suggested by clients, and we show how that could be used, how that could be adapted, where the captive can provide a invaluable financial tool for the university, for your particular entity. So you've now gotten in a little over 20 minutes, a little bit of reinforcement in the captive primer that was provided earlier. And then we've moved into a fairly high degree of sophistication. So if you have any questions, I'd be happy to answer them. If you'd like to email those questions, you can reach me at les.bowner@willis.com, and I'd be more than happy to deal with them.
Well, we do have the phone lines open, so if anybody has any questions.
Because, Emily, we're either losing people or people are deciding to ask a question.
Well, we're also getting an odd beep on the line, but I think if there aren't any questions at the moment, we will encourage people, excuse me, to email in if they have any.
Feel free. I enjoyed the opportunity, and we at Willis very much look forward to working with the UC system as you take these concepts beyond.
I just had one brief question, Emily. Do you plan to post this presentation on the UCOP risk website and along with Les's email address?
Yes, we will.
Great. And I don't know what the beep is. Sounds like somebody put us on hold.
It does sound like that. So I think at that we will wrap up. Thank you, everybody, for joining us, and we hope to see you for future toolboxes.
Thanks, Emily. Thanks, Les.
Bye.
Oh, okay.